Well, what do you get for a market that has everything it could want? Hi there everyone, welcome to the Trader Circle Weekly Market Update. Today is Tuesday the 9th of July 2024, and before I get started, you do need to be aware that whatever I say is general advice only, and you have to consider whether it's appropriate for yourself. So when I said that the market has everything that it could want, I'm speaking more so of the US market. They've got a scenario where they're expecting to grow earnings for their listed companies, yet they're also expecting an economic slowdown, but not too severe an economic slowdown, but just enough to allow interest rates to be cut. It's all a bit of an oxymoron. Are we going to get enough economic slowdown that earnings won't decrease, but that the interest rates will be cut? It's very, very sort of hard to achieve that without crashing the economy completely. And so we will get a bit of an update on this over the next 2 days with Fed Chair Jerome Powell testifying in front of Congress. He'll speak tonight and tomorrow night, and he's expected to say how good a job they've done in basically reducing inflation and yet keeping the economy relatively strong. He speaks after we saw US unemployment last week, and that was probably about where the market wanted it. Unemployment increasing very slightly, yet still a reasonable amount of jobs being created. Overall, though, I'm not sure that really leads to enough weakness for rates to be cut. Now, the market does have in its mind that US rates will be cut in September and that there'll probably be another rate cut before the end of the year as well. Whether or not that's the case is probably going to come down to further economic data. And later on in the week, indeed on Thursday night, right as Jerome Powell is speaking, we will see the next edition of the US CPI or inflation data. And that's actually expected to show inflation being fairly sticky. Headline inflation is expected to come down slightly, but core inflation, which is inflation with volatile energy and food costs removed, is expected to remain the same as it has been. And if that's the case, it's not at the level at which I think the Fed would be comfortable cutting just yet. And indeed, there are many members of the Fed who remain fairly hawkish or remain committed to higher for longer interest rates. And indeed, it's Jerome Powell, cheerleading the rate cut narrative. So Jerome's likely to be fairly dovish at his speech or his testimony tonight and tomorrow night, but whether the data supports that is another question. So three big events, two Jerome Powell speeches and the CPI data over the next two sessions, and markets could look fairly different afterwards. They could go higher again, or they could come down, but I suspect we will see some movement. With US markets having pretty much everything they could want, they have been pushing higher, and we've seen 4 record high closes in a row for the US market. In that scenario, it's actually pushed our market back to its own highs. Whereas otherwise, I think our market has been wanting to fall. It's only that continued strength in the US that's allowed us to sort of hold near our all-time highs, hold near our yearly highs, hold near our resistance level for the past year. And I would put our sort of reluctance to go much further down to the divergent rate outlook between Australia and the US. In the US, they are looking to cut rates potentially as early as September, whereas in Australia, we might actually see another rate rise on the cards. So Australian CPI has been stronger than expected. It's actually increased slightly over the last 6 months, and it's not really the conditions for which you'd expect to see interest rate cuts. Our data's been definitely more inflationary. We had the strongest CPI reading recently, and we also had stronger than expected retail sales last week, which again points to that sort of inflationary conditions. With all that going on for Australia, many have sort of theory crafted that we might see the RBA raise rates in August. Now, whether or not they do raise rates in August will probably come down to the quarterly CPI reading, so the second quarter CPI reading that'll come out at the end of July. And if that is stronger than expected, we very much are likely to see a rate rise here in Australia at the August meeting for the RBA. So that divergence between US cuts, potential Australian rate rise, is leading to the difference in the markets. US has set, I think 35 all-time highs this year for the S&P 500, whereas we set our all-time high at the end of March, and we really haven't gone further since then. So the divergent outlook on rates is leading to that divergence in the two markets. On top of that, we've got divergence in expected company earnings. Like I said, The US is expected to grow company earnings this year, whereas our company earnings, at least for listed companies, are expected to be lower this year than they were last year. And given that our market's about 10% higher than it was last year, it doesn't really sort of create the conditions for the Australian market to keep rising. So I did want to touch on sort of a bit of a tale of two cities this week. We've got the US market and the Australian market, but within the Australian market, we've also got the banks and we've got the miners. Together, they make up over 70% of our market. The banks closer to 40%, the miners closer to 30%, and the story of what our market is doing is based on these two subsectors. The banks have kept rising. The banks have pushed into, in some cases, all-time highs, in other cases, yearly highs, and they've kept grinding higher. And that's been necessary to keep, our market near its highs, while the miners have languished. The miners have really sort of suffered with iron ore prices going lower. They've headed lower throughout most of May and then early June. They did see a bit of a push up in late June, but over the past 3 sessions, they've come right back off. With such a tangible sort of thing to follow to watch miner profitability, it is really hard for them to join in the gains, and they've acted like an anchor on our index. With the miners coming off with the iron ore prices, it's really prevented our market from following the US to all-time highs. So as the miners have languished, the banks have pushed up and up and up, and they are extremely expensive. Depending on how you measure these things, our banks might be the most expensive banks on earth. And they've really had to keep rising in value to keep our market level and keep our market sort of in somewhat of touching distance with the gains that we're seeing around the world, and particularly from the US. Now, the banks can't do it forever. There will be a period where they see selling, and there will be a period where they trade probably significantly lower in price than they are now. And that's just simply a factor of the how expensive they are at the current levels. So that sort of, I guess, balancing act in our market is a really difficult one to maintain. And I do think that it sort of says, even if we are to follow the US up a little bit further, unless iron ore really comes right back up and we see real strong price gains in the miners, it's hard for our market to add too many more points. So we'll have a quick look at the charts for this week, and you guys can see what I'm talking about. This is the US S&P 500. They've been on a very nice strong uptrend for the past sort of 10 months now almost, since October last year. And over the past 4 sessions, on the S&P 500 at least, they've had 4 all-time high closes. They broke through 5,500 index points and they continued higher. I will just zoom in a bit, so hopefully it's a bit more visible in the video. And they broke through the previous all-time high, 5,500, and they've continued straight up since then. The pace of gains might be slowing, but really, what do you get a market that's got everything that it could want? It's got potential interest rate cuts in the future, it's got a potential soft economic landing, and it's got a potential for further earnings growth, if you believe all the forecasts. Unfortunately, I think it'll be a bit of a case of buy the rumor, sell the fact. I'm not sure all of those factors can be conveniently achieved, and I think something will have to give. But they're all still a bit of a way off in terms of being achieved. Whether we get the rate rise, it's still potentially 2 months away. Whether we see earnings growth continue, it's again still potentially a few months away. Whether we get that soft economic landing, again, it's out in the future. And so all of those factors, being what the market wants, acting like a carrot dangled in front of the market, and that's helped the US market to continue higher. We will see a US company earnings reporting season start at the end of this week. That's for a period that's just occurred, and again, expectations are high, but I think the major sort of earnings reporting season will be the 2 quarters after that. I think US companies will really struggle to justify the prices they've achieved with the earnings season, and so maybe check back in the next week or the week after, and we'll see what the effects of this earnings season are. For our own XJO, we can see that we've really, I will search it up here, just to bring the lines up. If I zoom out a bit, we can see that we've really been tracking sideways since the end of March. We set the all-time high at the end of March, and we haven't really gone much further since then. In fact, we've traveled in a very narrow range over those few months. The range has gotten narrower and narrower, and over the past 2 months, we've really not gone beyond a roughly 100-150 point range. Any positive news, we've sort of pushed back towards 78.50. Any negative news, we've pushed down towards 7,700. Where the US market hasn't risen, we've seen selling. And so I do think our market is looking for an excuse to sell, but with all-time highs consistently achieved in the US, we haven't really felt comfortable selling off just yet. If they do see any serious selling in the US, I think there is a lot of room to the downside for our market. And if they do keep grinding into fresh all-time highs, we will keep grinding into our all-time high as well. And look, if they do achieve enough of an all-time high in the US, we might set a small all-time high here as well. Overall, though, I think we're just waiting for an excuse to come down. So we'll wrap it up here for this week, guys. Hopefully you enjoyed. If you did, click like, click subscribe, and we'll see you next time.